touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for tuning into BQ Conversations. Arundhati Bhattacharya has been at the helm of the country's largest public sector lender and took tough calls as the chairman of SBI, be it taking action at some of the large errant borrowers or getting all the lenders to come in together to try and find solutions to a number of issues. She also oversaw one of the country's largest consolidations in the banking space. While these moves yielded some results, the banking sector as a whole and the PSUs in particular still under some pressure. What needs to be done to try and alleviate this stress, and what is the landscape looking like from a bird's eye perspective over the course of the next 3 to 5 years, if not longer? Let's try and find out from her, and let's pose these questions to her. She joins us on the show. Ms. Bhattacharya, thanks so much for taking the time out and joining us. Really appreciate your time. This is Neeraj here. Good morning. Now, before we get into this whole conversation about what the near term is looking like, if we just takes a step back and looks at the trends for the last many years, bank credit historically used to grow 1.5 times nominal GDP. The last few years, 1 times GDP, arguably due to lack of capex. And from the looks of it, there is no certainty that capex will return, even though one hopes that at some point of time in FY20 that could happen. What's your sense of how the space at large moves in towards over the course of the next couple of years?
Well, lack of capex and lack of projects obviously are one of the reasons, but I don't think that's all. I think in the last few years, banks have also been more risk averse. Not only that, they have tightened many of their underwriting standards. They have also now sort of diversified their lending book away from projects into areas such as retail and NBFC lending and stuff like that. So I think, it's been a change more or less from the way things were before, say, 2011-12, when we were looking purely at term loans and working capital, into doing many other things. So I think, this is something that's going to continue. Especially the focus on retail lending is something that everybody realizes is probably a good way of hedging your books. And I think that is something that's going to continue. In fact, I would say that one of the reasons why SBI came through all of this trouble was because of the strength of its retail book. We had an equally strong retail book along with the corporate book, and that enabled us to more or less hedge the difficulties that we faced on the corporate book. So I think every other lender who has the ability, they will continue to focus on the retail book. Also, as you know, the recent norms that the Reserve Bank of India has put out in respect of project lending, not more than 50% of a requirement of a project can come from the commercial banks. So the rest 50% has to be equity and market borrowing. So to that extent also, the possibilities of lending hugely for projects is also curtailed, and rightly so. So to that extent, I think we have to understand that we have to look at many other opportunities in order to restore the growth rate to what it was going forward. It cannot be only dependent on capex. Okay.
With an assumption that some of these moves get done, and we'll get to that conversation as well, the other big question, Ms. Bhattacharya, that always comes about is whether or not PSU banks can reclaim or try to reclaim or claw back some of the lost opportunities over the last decade. Now, two ways of looking at it. NPAs at 2 decades high, NIMs have fallen, and therefore the worst has happened. Or the other way of looking at it, because of the stress that still exists in the system, PSU banks will not be able to pursue growth. They'll be left rectifying what needs to be rectified in the book. How do you see that opportunity play out for PSU banks at large over the course of the next immediate next 2-3 years?
Well, PSU banks definitely have to up their game. There's no gainsaying that. And I hope that the time period that they had under PCA, that they have used that time fruitfully in order to gain the kind of processes and the kind of technology that they didn't have. Because today, you know, one has to understand that it's not a simple plain vanilla game anymore. You have to have the right kind of risk management processes, you have to have the right underwriting standards, and you have to have technology to back you up on all of these. Not using technology is no longer an option. Similarly, you know, in respect of digital, one needs to be able to exploit the digital platforms as much as possible in order to reduce costs and increase volumes. Because the margins have shrunk, therefore it is now more a volume game. And you can't play a volume game unless you have the right kind of technology. So I think, you know, the PSU banks, if they are to claw back whatever they have lost, they need to up their game on both of these two counts.
Aside from that, you know, just comment on the fact that while the tail risk for, you know, the state-owned enterprises have gone down considerably, you are seeing lower bad loans, higher coverage, higher CET1, given the recapitalization. The structural nature of the recovery, is that still, you know, a lot more left to be desired with regards to the overall weak PPOP underwriting, the market share loss that most of the PSU banks have been facing of late? Is there a lot of work left to be put in still?
Well, there is a lot of work left for the PSU banks without a doubt. Alongside of what I said about risk underwriting and risk management underwriting and technology, I think in respect of the PSU banks, two other things will make a big difference. One is, of course, capital. They need to have adequate capital to grow. And the other thing that I think they really need to think about is how are they going to bring in the PSU reforms that will enable them to get the right kind of human resources. I think human resources and the way we handle them has been one of the biggest challenges for PSU banks. And this, of course, is something that's been flagged time and again. And I do believe that the government has plans for doing something about it. But this is something where you have to create a level playing field for the PSUs. You know, for instance, there is a National Institute of Bank Management, which is actually funded by the PSU banks. It was set up about 40 years back by the Reserve Bank of India and the public sector banks in order to create specialists in banking. Now, the PSU banks are not allowed to recruit because this would be a campus recruitment from the NIBM. So the PSU banks fund NIBM, and yet the recruitment takes place by the private sector banks. Now, obviously, that kind of a non-level playing field is not going to help the cause of the PSU banks. They really need to make the playing field level in such certain respects in order to ensure that the PSU banks are positioned enough to claw back what they have lost. It's going to be an uphill battle all the way. And of course, as you said about NPAs, while the IBC has been a real blessing, and I think it's a great piece of legislation that has been done, it is obviously an evolving law. It's something that's getting tested frequently in the courts of law, and therefore there are certain delays. But we need to work through this to see what exactly is pulling down the proper execution through the IBC, and to ensure that, you know, it comes up to the promise that it had, to ensure that in return the economy itself benefits from this. And the point of putting in the IBC, that if there is a stressed asset, you put it back into production as quickly as possible so that nothing is lost, the resources aren't lost, the employees don't suffer, the customers keep getting the service, that aim that is fulfilled. Currently, I think we still have some way to travel before we are able to say that we'll be able to do this. But even then, I must say that that to have drafted this piece of legislation, to have got it passed, to have notified the regulations, put up the courts, sent accounts there to be resolved, and actually having resolved the accounts, that's an enormous body of work in the last 5 years. And I don't think there is any other country in the world that has managed to do so many things in just a small period of time. And so to that extent, I think this really has been a game changer for the banks in general.
Getting your point, ma'am, but just since you're on the topic of stressed assets, I just want to, come in with while the government on its own part has been doing whatever it has been doing to make sure that there has been enough recapitalization to pull out banks from the PCA framework. The other part about those bigger stressed assets and banks being asked to foot the bill to come in and rescue. I'm taking Jet Airways as a case in point right now. Does that probably, get you a step back instead of taking you a step forward?
See, I really do not know what is going on in respect of Jet Airways, and therefore it would not be fair of me to comment about this. All that I have seen is media speculation, and therefore, I don't really want to say anything about something which I know very little about.
Not in particular
but
to the Jet
I will
Airways.
say that if you look at many of the stress.
Yeah, go ahead.
Not if you are talking about not in particular Jet Airways, I think even earlier banks have tried to resolve stress outside of a framework that is very rigid. And that is when banks have felt that more value will be captured if you do this resolution outside of the NCLT. See, one has to understand that when we are taking a particular asset to the bankruptcy court, there is always a very large possibility of it going into liquidation. And when an account goes into liquidation, unless there are hard assets, the realization always is very poor. For instance, you take the realization of, say, a steel unit, and you compare that with the realization of an EPC unit. You will find that in the steel unit, the haircut is far less than in an EPC unit. So any services unit, if you take it into liquidation, automatically the amount that you can get back is far less than if you take a manufacturing unit that has hard assets behind it. I think it is because of that banks normally try to resolve such service assets outside of the framework of the bankruptcy that leads to liquidation. Okay. Now this is in general, it has nothing to do with what is happening to one airline company or some other company or the other, because I have no idea about what is going on there, and again, as I said, it is not correct for me to comment on that. But in general, this would be the mindset of the banks, and I think that is what we are seeing playing out.
Ms. Bhattacharya, whether or not these resolutions happen in the next 3 months or 6 months is one thing. But if I take the next 2-year perspective, the general belief is that due to resolutions, some of the large written off NPAs will come good, and that will only augur well for the P&Ls of a bunch of these PSU banks, or arguably a lot of corporate facing banks. You reckon that it will happen in a bunched up way and will be a big booster for all the corporate facing banks?
See, whether it will be a big booster or not, I do not know. But obviously, as these assets get cleaned out, they go out from the asset book. So, your denominator actually comes down to that extent, and your NPAs go down because they are always a percentage, So to that extent, if you have a lot of assets that are non-performing sitting in your asset book, all of your ratios get impacted by that because they are not earning anything. They are at zero return. So all of your ratios that are dependent upon the size of the asset book and the returns from that asset book, they all get hampered because of this. Now, as a result, when you start taking these out, when you clean them out, obviously, to that extent, the balance sheet starts looking so much better, your ratios become much better. So that is something that's definitely going to happen with the banks that have had this corporate banking-led model. As you rightly say, all of the banks that were corporate-facing, they will all benefit from this. Write back of provisions, it depends from bank to bank how much of provisions they had made on those accounts, and definitely some amount of that will get written off if it is over and above whatever other haircuts that they are having to take. But as you said, they need to be resolved quickly. And I think that is where, we need to focus as to how to get these things done as quickly as possible. Believe me, if an asset is resolved within 6 months, the value that it realizes is far superior to if it gets realized in 3 years' time. And that's where, we have to realize that every single day lost means some amount of value eroded. And we need to work through all of this, these processes so as to ensure that that speed that we want is actually brought into the system. Having said that, Many people across the world have told me that 270 days is way too rigid, and probably a year is the right kind of time frame. And you are looking at a very optimistic time frame when you say 270 days. But I feel that India, has done so many difficult things, we can do this as well. And that's where we need to focus.
You reckon, Ms. Bhattacharya, that with whatever little you've seen in your functioning capacity and then as an oversight capacity, if you had one, or just looking at the scheme of things, that the next 1.5 to 2 years will not be years of PSU banks largely and some corporate-facing banks grappling for capital to survive, but getting capital for growth due to resolutions, due to recapitalizations, due to maybe equity market movements and some fundraising. Do you think capital for growth will be available for these banks over the course of the next 18 months?
See, it all depends on how they approach the matter. I do know that the government has been stressing on the fact that many of the PSUs must sell their non-core assets. Quite a few of them have a number of non-core assets that they can definitely sell and raise capital. It will also depend how much of work they have done in order to ensure that their own house is in order. Because, even when you have very good quality data, you can end up saving quite a bit of capital. Similarly, it will also depend upon what kind of assets they take on their books. Because if you reduce the risk weights of the assets, then again you can save capital. See, there are multiple ways of approaching this capital issue. Having said that, I think, it's time that the PSU banks realize that they have to stand on their own feet, that they cannot look to the government every time for capital, and they have to somehow or the other garner this capital themselves if they wish to grow.
The other point, to that would be for the state-owned enterprises, for the public sector banks, now picking up deposit market share. I mean, as per a report that I'm just reading, it says that the overall deposits have been weakening and have reduced to almost 30 to 35% in FY18 and the first 9 months of FY19, and versus 55% average in the last 3 years. So that's a big differential that they need to cover up.
No, I agree with you, and I think that is where, they need to show their mettle, because the depositors have always been their traditional customer base. If they are losing out on the deposits, obviously they'll lose out on the other bits of business that these depositors were giving them. And therefore, they really need to pull up their socks and get on with it. Losing the deposit base is something that is extremely worrying, not only for the PSUs, but also in general for banks. If you have seen, the credit growth in the last, I think, 2 to 3 quarters has been outstripping the deposit growth. And I was very heartened by the steps taken in this budget in order to make deposits a little more friendly as compared to the mutual funds. Because of the TDS that the depositors had to accept, it was always a challenge for those people who understood these matters as to whether they would keep a little bit of extra money in the banks or in the mutual funds. While I think, mutual funds also needs to be supported, and it's something in this country at least that it needs to grow well. But on the other hand, I think the banks also had a bit of a handicap where deposits were concerned. That has been put right in the recent budget to some extent, and I hope that the banks will benefit from it. In fact, I think I saw a recent media report that the deposits had crossed the double-digit mark, I think, in the last 1 month or so. So I hope that there is some benefit that the banks will get. But the market share loss that the PSBs have had in this area merely points to the fact that they were not in a position to give the loans. When you are not able to service all of the needs of a customer, that customer will take whatever business is there with you away to somebody else who can give them the whole bouquet. And therefore, it's important for the public sector banks to realize this. I'm sure they already have, and to be able to tone up their operations in a manner that will enable them to give all of these kinds of products to the customer and reduce the pain points of the customer. Just recently, in fact, today itself, not today, I think 2-3 days back, we read about SBI having put in a process of withdrawing cash from ATMs without the ATM card. Now, obviously, that's addressing a particular customer pain point wherein there are several older customers who fear using an ATM card because they're scared that it might be cloned. Now, it takes away that difficulty from them. So, the PSBs in general need to look at what are the customer pain points, address them, come with a whole bouquet of products. And I think, you know, given the trust that they have traditionally had with customers, they can definitely try and recoup some of the market share that they have lost.
All right, so that's one side, obviously, that now we are looking at a focus point for PSUs. The other point being, obviously, in the entire issue with regards to NBFCs, bank lines were considered one of the primary sources of funding for NBFCs. How is that situation looking like from a banking perspective, and whether or not they have become a little bit more tight-fisted in terms of giving out those wholesale fundings?
So I think, you know, NBFCs also now need to understand that they can't be lazy on the liability side. You know, for the NBFCs, the main concern always was how to make their assets grow. Now they also have to take into consideration as to how their liabilities grow. And that's how NBFCs should be. It shouldn't be a question of banks taking deposits, passing on the money to the NBFCs, and the NBFCs then doing the last mile lending. That cannot be the model forever. And I think it's good that the NBFC crisis happened when it did, before the NBFC sector had become too large for them to have posed a real big systemic issue. So it's good that this kind of a thing has happened. People have sort of now woken up, they're on their toes. They know that they have to garner more funds from various sources instead of only depending upon the banks. And I think, you know, as a result, the whole of the industry will mature. So it's just not a question of getting a license, getting a line from the bank, and then going to the tier 3, tier 4 cities and doing lending. It's much, much more than that. And that's how it should be.
Ms. Bhattacharya, your thoughts on the recent SBI move to link the savings deposit rate with the repo rate?
See, it's a good move in the sense that obviously it's much more transparent. So you know the basis on which your rate is getting fixed. So it's definitely a much more transparent process. The reason why it has not been done in the banks for so long is that when you link one side of the balance sheet to a market determined rate, you have to link the other side of it just as well. For a very long time, as you know, the bank deposits have been the de facto social security measure that India has had. Because most of the older generation, people who are pensioned off, they prefer to keep the money in the banks because they don't have the risk appetite of going into the markets. And if they are going to keep the money in the banks, they need a stable income. Now, if your deposit rates are going to fluctuate along with the market, it's very difficult for a householder to plan how he is going to spend his money, because from month to month he doesn't know where his deposit rate will be and therefore how much he's getting in his hand. And that's why SBI has done a good thing of introducing it, but introducing it only for the portion on which the householder doesn't necessarily depend in order to run his household, which is the savings bank balances. And as you know, savings bank balances, you don't need to keep too much there. You can always sweep it into a fixed deposit. The sweep is automatic. If you need more, the breakage of the fixed deposit is also automatic. So people don't really need to keep a lot of funds over there, and therefore they have found it safe to link that portion to the market rates. This is something that happens as any society or any economy matures, and we are slowly maturing. Therefore, I think the time has come for doing something of this nature. It's the right step in the right direction. We'll have to see how it plays out in the Indian context before we venture further on this road.
All right. Ms. Bhattacharya, lots that we have spoken about. Just one final question that wraps up this conversation. You know, as an industry veteran, you've been in this industry for a really long time, and you are aware of the current standing. Just highlight for us 2 or 3 aspects that one closely watches out from the PSU pocket, whether on the side of a threat or whether on the side of an opportunity that lies ahead for the PSU banking space.
Well, 2 or 3 things that you should watch out for in the PSU banks. You need to watch out for how they are coming along in the technology journey and in the capital gathering. If they are successful in these 2 counts, then I think, they have a decent chance. The second thing you have to watch out for are the mergers, because I think, from whatever this government has been saying and whatever steps they have taken, they have more or less felt that, it is important to consolidate the PSUs. So the mergers could be a challenge in the shorter term, but in the medium term, they definitely will create stronger institutions as long as the human resources side of it is addressed as well. So I think that's another space that you need to keep watching. And third, of course, I will say is the PSU reforms. How well do they go, and where do they actually lead to? That is something that's really going to give you a flavor as to how the PSUs will perform in the future.
All right, Ms. Bhattacharya, really appreciate you taking the time out and joining us today and giving us your thoughts. Thanks so much for being with us on Bloomberg Quint.
Thank you. Thank you so much.
Well, that's as important a voice as you can hear on banking. And, well, I think anybody's guess as to what will happen to some of the PSU banks over the course of the next couple of years. But maybe, just maybe, capital might be a bit easy compared to what it has been in the last 5. The markets marginally in the green. The Nifty Bank, too, which was down about 0.5% in the red, is now flattened out completely. Maybe, just maybe, IT stocks and some others are leading the charge, because the Sensex is up about 77 odd points. Not a bad start, flattish. We'll wrap it up on this leg of Indian Open. From Devina and me and the team that put this show together, thanks so much for watching. The FNO show takes forward the action on the other side.